Thanks for joining us. We should have a real good presentation today. Folks, Tom Smith here doing another test, getting a couple of requests from some of you out there just asking me to speak so you can adjust your speakers. I hope this is assisting you. For those of you that have questions, by all means, feel free to put them in the question and answer section or the chat area. We're going to get started at 3:30 sharp. Thanks for joining us. Good afternoon, folks. Just doing one last sound check here, just to go ahead and calibrate your speakers. Today's special guest is Chuck Hughes. I'm looking forward to his Trading Weekly Options presentation. This is going to be a recorded webinar, so we're going to have it archived at www.mytrademonster.com tomorrow afternoon. For those of you that have questions today, we're going to have basically a pretty much packed session. So put your questions in the chat area, the question and answer section. We'll be sure to address them as promptly as possible. For those of you that have questions for Chuck, Chuck's going to be putting up some support staff numbers where you can contact him and his support staff to address any questions that you may have at the end of the presentation. As well, Chuck's free report, which he's been kind enough to go ahead and allow us to send out, will be coming sometime tomorrow afternoon for fulfillment on that. Otherwise, we're going to get started in a couple of minutes. Thanks for joining us. Hi, folks. Why don't we go ahead and get started? Tom Smith here from TradeMONSTER. Thank you very much for joining us. Today, our special guest is Chuck Hughes, and Chuck Hughes is going to be covering some of his trading of weekly options. Chuck, are you with us?
Yes. Can you hear me, Tom?
I can, Chuck, and thanks for joining us. I know we have a lot of people anticipating a pretty good webinar, so why don't we go ahead and get started? I'm going to go ahead and pass the reins to you, and then we can get the presentation going.
Okay, sounds good.
Coming over now, my friend.
Okay.
Okay, I see it. All we have to do is a slideshow, and we're good to go.
Okay, I'm setting it up as a slideshow.
Perfect.
Okay, great. Good afternoon, everybody. This is Chuck Hughes. Thanks, Tom, for taking the time to put on this webinar today. We're going to talk about trading weekly options. And I've been trading weekly options since 2010. I'm very active every week. I do weekly covered calls to generate income, and I've been averaging about taking it about $15,000 a week in cash income from trading weekly covered calls. And I also purchase weekly call options, and I'm going to show you my trade selection process today I use to select those options. And I'm also going to show you my results from the covered call trading over the past year. It's those weekly premiums that you collect each week really build up over time. So I'm going to show you my account statement showing that income. So today we're going to explore two of the weekly option strategies that I use daily, and that is the option purchase strategy and also, as I mentioned, the weekly option income strategy. And I'm also going to give you 2 weekly option trades that you can take tomorrow. Then we'll have a question and answer session at the end. I'll be glad to answer any questions. So we're going to look at some actual trade results to show you the results of my option purchase strategy, my trade selection strategy. And I'll show you brokerage accounts that show over $1.8 million in option profits over the last 5 years using this trade selection process. I'm also going to show you my brokerage confirmations that show over $750,000 in cash income over the past year from selling weekly option premiums. So those of you that are not familiar with weekly options, they started trading in 2010, and the weekly options start trading on Thursday. So tomorrow they'll start trading the weekly options. I believe that would be the February, let's see, today is the 19th, so tomorrow is the 20th. So they'll start trading the February 28th weekly options starting tomorrow, and they'll expire the following Friday, so they'll expire on February 28th. So they have a trading life of 6 days. So with weekly options, you can start small. You can purchase weekly options and start out with a small account and trade 4 or 5 options in a diversified portfolio. And I'm going to show you a portfolio I traded that had 5 options in it, and the total cost was only $270. So you can start out small with these weekly options with the weekly option purchase strategy. And weekly options give you 52 opportunities each year to profit. In other words, there's 52 expirations every year. So what I've been doing over the years is I roll over my weekly options each week, and that allows me to compound my returns. And I'll show you how I roll over these options each week using a option spread order. So the overall goals of trading weekly options would be, number 1, price appreciation with weekly option purchases, and number 2 would be generating income from the sale of option premiums each week. And I'll show you examples of that, of both strategies. Let's take a look first at the option purchase strategy. And as you know, options are leveraged, so they provide more profit potential compared to stock and ETF investing, but at the same time, that leverage also incurs more risk. And what I'm showing now is a option chain for Home Depot stock, and at the time it was trading at 77.73. So if you were to purchase the at-the-money call option at the time, which would have been the 77.5 strike call that had 67 days to expiration, that would have cost a bid of $320 and an ask of $330. So let's assume that we purchased this at-the-money call that had 67 days to expiration. And what I did is I inputted that information in the call option purchase calculator, and what this will do is calculate the profit potential for buying that 77.5 strike call option at $325 with Home Depot stock trading at 77.73. So this will give us the profit potential for this option purchase, assuming various price changes in Home Depot stock, and in this example, from a 10% increase in the stock to a 20% decline in the stock. So this will give us an idea of the risk-reward potential for purchasing options. So we can see that this option purchase is high risk. If Home Depot stock remains flat at option expiration and it's trading at 77.73, we would realize a 92% 0.9% loss. So the stock stays flat, you're going to lose 92%. If the stock goes down at all, you're going to lose 100%. And if the stock goes up 5%, you'll make a 26% return. So what I'm trying to indicate here is these option purchases are very risky, and you're always risking 100% of your premium each time you purchase an option. So what we want to do is use a high probability trade selection system to select these options so that we don't incur these big losses, and I'll show you how I do that. And as it turned out, Home Depot closed at 75.38 in this example, and it did result in 100% loss if you had purchased the at-the-money call option. So option trades can easily result in 100% loss. And what I'm going to show you today is my Prime Trade Select option selection process. And the goal of that is to avoid these large losses, which can knock you out of the game. Now, this is a price chart of the volatility index, the VIX index. And this is the daily price movement. These vertical lines are the daily price movement of the VIX index. And we can see every one of these spikes in the index represent a market sell-off. So if you're purchasing options in this kind of market and you have these sell-offs on a regular basis, that option purchase can easily result in 100% loss. So I just wanted to present the risks involved with option trading, and you can see every one of these spikes represents a market sell-off. So if you have bad timing when you purchase an option, you could easily lose 100% of your premium cost. So with weekly options, as I mentioned, you can start out small. I started trading options 30 years ago, and all I could muster at the time was a $4,600 trading account. But within my first 2 years, I realized more than $460,000 in profits. And as it turned out, that was more than I had made the previous 6 years as an airline pilot. So I got really interested in option trading when I got those kind of results my first 2 years, and I've been at it ever since. These are just copies of my tax returns those first 2 years, showing that $460,000 in profits from options. So I use what I call the Prime Trade Select, and this is a trade selection process we go through to select options with the highest probability of success. And it's a 3-step process. And the first step is that we want to determine the price trend of the stock, and we use trend following systems to do that. And I'll show you the 2 trend following systems we use for to select weekly options. Step 2 is we want to confirm that price trend, determine the extent of the buying or selling pressure, and isolate the very best profit opportunities. And step 3 is to select a low-risk entry point using the Keltner channels. Now, this is really an important part of the process. We want to get a low-risk entry to avoid that 100% loss, to avoid that bad timing. And I'm going to show you some trades I just took in the last couple of weeks, and I'm going to show you how I use the Keltner channels to get a low-risk entry, and those trades are doing very well right now because the market didn't retrace after I purchased those options because I found a low-risk entry point using the Keltner channel. So we have a 3-step process to select high-probability option trades. And when the Prime Trade Select system is on a buy signal, we're going to purchase call options, And when prime trade select is on a sell signal, we're going to purchase put options. And I just wanted to mention that prime trade select has worked. It works well in both bull and bear markets, and it was very profitable during the last two bear markets because we had mostly all short positions in the last two bear markets. And as a trend follower, I simply followed my trend following systems, which led me to short positions, and we were able to realize nice profits during those last two bear markets. So prime trade select works both ways. Okay, so step one is we want to use the trend following systems to determine the price trend, and we use two different trend following systems for trading weekly options, which I'll show you about. And again, these were both of these systems were profitable during the last two bear markets because we had mostly bearish trades. Now, the goal of trend following is to quantitatively measure the buying and selling pressure of a stock, and this allows us to follow the trend instead of trying to predict where the trend is going to go. And I like to use a system instead of making emotional decisions, and I've been using this basic trend following system successfully for the past 30 years. So all in all, the trend following is probably the overall best strategy to use for the average investor. It allows you to use a system to make decisions rather than try to guess where a market is going to go. One of the trend following systems I use is the exponential moving average trend following system. And what we do is we look at the 50-day exponential moving average of a stock in relation to the 100-day exponential moving average. And if that 50-day EMA, which is the faster EMA, if that's above the 100-day, then that stock is on a buy signal. And if the 50-day EMA is below the 100-day, then that stock is on a sell signal. And here's an example. This is for the Internet Index ETF. And what I'm showing here is the daily price movement of this Internet ETF. You can see these vertical lines represent the daily price movement. And the blue line here is the 50-day exponential moving average line. The red line is the 100-day exponential moving average line. So we can see that the 50-day is above the 100-day, so this ETF is on a buy signal, and it will remain on a buy signal as long as the 50-day EMA is above the 100-day EMA. I also use MACD or MACD. That's the moving average convergence divergence. And with MACD, I use the 24, 52, and 18 for the parameters. And a buy signal is indicated when the 24 and 50-day MACD line is above its 18-day exponential moving average. So let's look at an example of that. This is again for the Internet Index, and we can see the 24 MACD line is this black line. So when that crosses above its 18-day EMA, then that stock or ETF is on a buy signal. We can see that the Internet Index is currently on a buy signal. Now, this MACD is shorter term than the EMA system, and it's also more of a leading indicator. So for short-term trading, we'll use the MACD to generate signals, as well as the 50-day and 100-day exponential moving average system. So we use both systems to generate short-term buy and sell signals for weekly options. Okay, step 2 of Prime Trade Select is confirm the price trend. And on any given day, there can be hundreds of stocks on a buy signal. So what we want to do is use confirmation indicators to help us narrow down that list to the stocks and ETFs with the best profit potential. And I just wanted to mention the Prime Trade Select system, the 3 steps. We've gone into this in detail in previous webinars, so those are all recorded. So if you wanted to get a more detailed look at Prime Trade Select, you can take a look at some of those previous recorded webinars. We went into great detail on all 3 steps. Today, I'm just going to review them quickly because we've already covered those in previous webinars. Okay, one of the confirmation indicators we use is called on-balance volume, and it measures volume flow with a single easy-to-read line. And volume flow precedes price movement and helps sustain the price trend. So we like to take a look at this on-balance volume and confirm the present price trend, and we want to see the on-balance volume line sloping up to confirm a price uptrend, and we want to see the on-balance volume line sloping down to confirm a price downtrend when we're taking a short position. So again, we use these indicators to select both long and short trades. And this on-balance volume can be downloaded from the tradeMONSTER platform. And when a stock closes up for the day, volume is added to the line. When a stock closes down, volume is subtracted from the line. So a cumulative total of these additions and subtractions form the OBV line. And here's an example of the OBV line. This is for the Internet Index ETF, symbol FDN. And this bottom chart here is the on-balance volume line, which is this line right here. And the numerical value of this on-balance volume line is not that important. We simply want to see this OBV line sloping up. And if it's sloping up, then it confirms this price uptrend. And another confirmation indicator we like to use is the new 52-week high list. And I found out through experience over the years that stocks that are making a new 52-week high, they're in a very powerful uptrend, and they continue, or they tend to continue that uptrend longer than you might think. So the stocks that are making a new 52-week high, they tend to continue that price uptrend. It confirms the price uptrend, and it allows us to further narrow down our list of buy stocks with the greatest profit potential. And I check this new 52-week high list almost every day, and you'll start to see certain stocks show up on this list, and those are the stocks I like to focus on. I like to pick out one in each industry and then focus on those stocks. So they represent the very best profit opportunity if they're making a 52-week high, because to make that list, they're in a very powerful price uptrend. So that's actually, this list is actually a good place to start your trade selection if you're just starting out and you want to create a list of potential buys. This is a good place to start. You look on that new 52-week high list, and if you check that regularly, you'll start to see certain stocks show up on that list on a regular basis, and those are the stocks I like to focus on, and that's how I develop my stock and option picks from this new 52-week high list. So here's another daily price chart for the Internet Index. And again, the vertical lines here represent the daily price movement. We can see it's obviously in a price uptrend. We have the 50-day exponential moving average above the 100-day exponential moving average. We can see that the price is making a series of new 52-week highs here. So this confirms that price uptrend, and it just recently made a new 52-week high I believe it was yesterday. And we can see that the on-balance volume line for the internet index is sloping up, and that again confirms this price uptrend. Okay, so once we develop a list of stocks that are potential buys, the next step, the third step, is to select a low-risk entry point. And what I like to do is once I develop a list of potential buys, I'll wait for that stock to pull back a little bit before I buy that stock or buy a call option in that stock. So what I like to do to help me time that entry is use the Keltner channels, and they're very useful to help you time your entry and exit points for a stock or option. They also provide high probability buy and sell signals, and they can also be used to help select option strike prices. And I also use the Keltner channels to select stocks that have repetitive and predictive price patterns. So a very useful tool for your daily trading. And what I'm displaying now is an example of the Keltner channels. This is the daily price chart for the SPY, S&P 500 spiders. And these vertical lines here represent the daily price movement of the SPY. And then overlaid, I have the Keltner channels. There's three channels. This blue line on top here is the upper channel, and the dotted line in the middle is the middle Keltner channel, and then the lower line here is the lower Keltner channel. So the Keltner channels act as an overbought, oversold indicator, and they can help us time our entry into a stock or option. And the idea is when the price movement of a stock is getting up near this upper channel or is above it, then that's an indication that the stock or ETF is getting overbought. And when the stock trades near the middle or lower channel, that means the stock or ETF is getting oversold. So we don't want to buy when the stock is trading up near this upper channel or above it because it's becoming overbought. We want to wait until it retraces towards this middle channel or the lower channel before we buy. And you can see, again, this is a price chart for the S&P 500. You can see when the S&P 500 index, when it gets up near this upper channel or above it, you can see it's getting overbought, and then it retraces. Overbought, retraces, overbought, retraces, overbought, retraces, overbought, retraces. So it follows a pattern that usually when it gets overbought, it retraces, and when it retraces, it gets oversold, and then there's a subsequent rally. So you can see oversold, rally, oversold, rally, oversold, rally, oversold, rally. So very useful tool for helping you enter your position and find a low-risk entry. And I'll show you a couple examples of this. A couple weeks ago, here's a daily price chart for Google, and we can see that Google has had very strong rally over the past year, and you know, I wanted to participate in this rally. The question is, where do you buy when a stock is moving up this much? Where can you get a low-risk entry? Because you don't want to just jump in on a stock that's rallied this much. So what I did was I waited till Google retraced towards this lower channel right here. And once it retraced towards the lower channel, it was getting oversold. So I went in and added to my existing position. And on January 27th and January 28th, I bought the 900 strike mini call. So I added to my Google position right here, and you can see Google was oversold, and then there was a subsequent rally after this oversold condition, and the 900 strike mini call is trading around 305. So I have about a 29% return on this option right now. And you can see how the Keltner channels help me find this low risk entry. So if you use these Keltner channels, they can help avoid that risk you take whenever you buy an option, which is always 100% risk. So what you want to do is time it and try to get a low risk entry where the stock doesn't retrace because it's already oversold, and this allows us to find low risk entries. Here's another example. This is for MasterCard. We can see MasterCard's been in a strong price uptrend. The question is, if you want to buy a stock or an option, where do you jump in when a stock has rallied this far? So what I did is I waited again till it retraced below this lower Keltner channel. It was getting oversold, and I added to my position and bought the 65 strike call option. Here's one more example. This is for Apple, and we can see Apple got oversold here. It traded below that lower Keltner channel, so I bought the 450 strike mini call option. And these mini call options that I bought on Apple and Google, that's something that's relatively new. And mini options are 1/10 the value of a regular option, so it covers 10 shares of stock instead of 100. So you can purchase these for 1/10 of the cost of the normal options. Here's one more example. Recently, Minnesota Mining, 3M, again in a very strong uptrend. Retraced here, got oversold, so I bought the 100 strike call. So these are just examples of how we use these Keltner channels to help us find a low risk entry and avoid being stopped out of our option by buying the option when the stock is oversold. Let's look at a couple weekly option purchases I made in the trade selection process. I went through to select these weekly options. In my trading account, I have two different retirement accounts, and I trade the weekly options and as well as monthly options in both of these retirement accounts. So I have the option purchase strategy along with option spread strategies and covered calls. So I'll show you a snapshot of those, my retirement account here shortly. So let's go through the trade selection process. This was to purchase a weekly call option for Microsoft, and I'm displaying the daily price movement for Microsoft, and we can see that the stock was making a series of new 52-week highs. The 50-day EMA, which is this blue line, was above the 100-day EMA, so it's on a buy signal. We have a series of new 52 weeks highs to confirm that buy signal. We can also see it has an upsloping on-balance volume line to confirm that price trend. So what I did is I bought 5 of the February 18th weekly options, the 30 strike calls at 52 cents. Now I purchased these on February 14th, and I sold the 5 calls at 118 on February 17th. So I held these weekly options for 4 days and bought them for 52 cents or sold them for $1.18. So I had 126% return over those 4 days. So these weekly options, you can purchase these in smaller trading accounts. Again, this only costs 52 cents, or $52 for each contract. So these can be traded in smaller accounts. So over that 4-day period, I got 126% gain on Microsoft. Now, let's compare the leverage of options, and we'll compare that to purchasing the stock. So we saw where the my option trade produced 126% return. Now, over that same 4-day period, the underlying stock, the Microsoft stock, increased 3.2%. So we can see that the option trade provided 39-to-1 leverage compared to the stock trade. So again, here's an example: 3% stock return, and as compared to 126% return for the option. So these options are highly leveraged, and they allow you to get an increased return compared to stock investing, but of course they also incur more risk. Here's another trade example. This was for Home Depot stock, and we can see the daily price graph here. Home Depot was making a series of new 52-week highs, 50-day EMA above the 100-day EMA, upsloping on balanced volume line to confirm this price uptrend. So I went ahead and bought the February 18th weekly calls, the 46 strikes at 31 cents, and then sold them 5 days later at 50 cents. So this worked out to be about a 61% gain. And here's a portfolio. This is weekly options that expired on February 17th. And if I purchased multiple contracts, but if you were to purchase just one contract of these 5 options in different industries, it averaged out to about $54 per option, or about a total cost of $270 to purchase the 5 options if you purchased one contract. So you can see that these can be traded in smaller accounts. Here's another example. These were the March 2nd weekly options, and the average cost to purchase one contract of these options is $59 or $236 for the portfolio on a one contract basis. So what I like to do with my option positions, both my option call purchases and also the weekly covered calls, is I like to roll over the weekly options if the underlying stock still qualifies on a prime trade select buy signal. So if it still qualifies, I like to roll the option over. And here's an example of an actual spread order I used to roll over the Microsoft option. And I sold to close the February 24th weekly option, and I bought to open the March 2nd weekly option. So closing out the February 24th weeklies and buying the March 2nd weeklies, this is the actual spread trade that I used to roll over the options. And if you use a spread trade like this and use a limit order, it can help you save on the bid-ask price for options. And I usually put the order in around midpoint between the bid and the ask, and a lot of times I can get filled on that. So using the spread order can help you save on the bid-ask spread costs of rolling over the option. And in this case, I closed out the February 24th options, and the profits on that exceeded the cost of the March 2nd option. So I was able to, by rolling over, I was able to get a riskless trade, and it didn't cost me anything to buy these March 2nd weeklies because I had the profits from the February 24th, which exceeded the cost basis of the March 2nd option. So rolling over options can allow us to reduce the cost basis of the new option and also compound our returns. Okay, I'm going to show you 2 recent snapshots from my 2 retirement accounts, and I trade a combination of option purchase trades, option spread trades in stocks and ETFs, as well as covered calls, and I also trade both weekly and monthly options. So this recent snapshot from last month, in these 2 accounts, I had over $707,000 in profits, open trade profits. And what I did is I went ahead and circled just the option purchase trades just to give you an idea how that strategy is doing. And I had over $98,000 in open trade profits for the option purchases. And I circled these option purchases. And again, these are a combination of weekly and monthly call options. And this was in a retirement account number 1. And you can see I had options on Apple, AIZ, Amazon, Boeing, Google, Lincoln Financial. And here's a continuation of that. MasterCard, 3M, Netflix, Starbucks, and the healthcare ETF. So what I did is I just circled the option purchases just to give you an idea how that strategy is doing. Here's retirement account number 2. And again, I circled just the option purchase portion of my portfolio. So about $98,000 in open trade profit. So over the last 5 years, we've had some really volatile markets. We had a global financial meltdown. We had a severe recession, bear market, high unemployment, increased volatility. So it's been really tough to make money the last 5 years. But the Prime Trade Select did produce over $1.8 million in actual profits over that 5-year period. The average return on these trades was 85%. I had 183 winners, 17 losers, so about 91% accuracy. I'm just going to go through these quickly. These total, again, over $1.8 million in profits. Here's a TradeMONSTER account, profit $22,000, average return 198%. This was one of my contest trading accounts here. So I'll just scroll through these. These are different time periods over that 5 years, different industries. Some are ETFs, but you can see that the Prime Trade Select has done pretty well despite the difficult market conditions. Okay, let's take a look at a couple of trades that you can take tomorrow. The February 28th weekly options start trading tomorrow. So I took a snapshot of MasterCard, and you can see it's been in a powerful uptrend. Recently has retraced, and the price of the stock, which is the vertical line here, you can see it actually closed below the lower Keltner channel, and that doesn't occur very often. And that's what I call a high probability buy signal. When the stock actually closes below this lower Keltner channel, there's usually a pretty strong rally that follows this type of oversold condition for a stock. So there's one idea for purchasing a call option. And here's a price graph of the Russell 2000 small cap index, symbol IWM, and the trade weekly options on this IWM. So you can see it's been in a strong price uptrend over the past year, recently retraced, closed below this lower Keltner channel. And again, that usually sets up a high probability trade once a stock or an ETF gets this oversold. So there's two ideas for weekly options. Okay, and we're going to talk briefly about weekly covered calls. And this is something I've been I've been trading weekly covered calls since 2011. And what I like to do is, if I'm going to trade a weekly covered call on a stock or ETF, I like to hold that stock or ETF in my account. And then what I'll do each Friday is I'll roll over the weekly option and I'll close out the expiring option and purchase or sell to open. In the case of a covered call, I'll sell to open the new option. And that way I don't get called on my stock or ETF. And that way I just keep it in my account. Each week I just close out the expiring option and then sell to open the new option, and then I just keep rolling that over. And I've been doing that since 2011. And the way these weekly calls are initiated is you buy 100 shares of a stock or an ETF, and then you sell a weekly call option. And you can also do this with the mini option. So if the stock, like Google or Apple, if it trades a mini option, then instead of buying 100 shares, you only have to buy 10 shares and then sell the weekly mini option. So just the basics on option premiums. If you sell an option premium, then cash is credited to your brokerage account. So each week I sell these weekly options, and each week that cash is credited to my brokerage account when I close out these options and then sell to open the new option. So we can collect a premium every week if we sell weekly call options. And to give you an example, if you sell an option that has a 4-point premium, then $400 in cash is credited to your brokerage account. So this cash credit, it reduces the cost basis of the stock or the ETF and reduces the overall risk of the trade. And selling weekly options, it allows you to compound your returns very quickly. So if you're selling a weekly option premium every week, you're going to be adding cash to your account every week. And then over time, you can trade more covered call trades, which is exactly what I've been doing over the last several years with these weekly options. And if you sell these option premiums weekly, it can lead to a 100% cash-on-cash return regardless of the price movement of the underlying stock. And I'll show you some examples of that here shortly. So if you were to invest $4,000 and you wrote weekly covered calls, over the course of a year, you could collect $4,000 in cash. So this type of strategy has been profitable in every type of market condition. And it's also less risk than if you just owned the stock or the underlying ETF, because each week you're collecting cash and that's reducing your cost basis. So it's actually a lower risk strategy than owning the stock or ETF. So again, weekly options, they start trading on Thursday, they expire the following Friday, so they have a trading life of 6 days. So we get 52 opportunities each year to sell option premium, and this allows us to roll over the profits and compound our returns, and I'll show you some examples of that. Now, I use the covered call strategy in my 2009 trading competition, and even though at the time I was trading monthly options because weekly options were not available back in 2009, I had a $122,000 profit that year on a $100,000 starting balance. So these covered calls can produce a really good yearly return if you roll it over and start compounding your results, which is what I did in this case, and wound up with 122% annual return with these covered calls. I've made as much as $68,000 in profits over a 1-month period last year with these weekly covered calls. So let me show you an example of a weekly covered call. This is for the ETF symbol TNA, which is the small cap index. This is the leveraged small cap index. Now, I've had this for several years. So what I like to do is I'll hold these shares of TNA in my account, and then I'll roll over the weekly options each week. That way I get to keep my shares and they don't get called. So what I'm showing you here is a rollover that I did for these 800 shares. Now, keep in mind, I already had this ETF in my portfolio. I've had it for several years. So in this case, in this example, I was closing out the November 23rd weekly calls, and I was selling to open the November 30th weekly call. So this is just an example of a rollover, and at the time, the TNA was trading at 54.27. So with TNA trading at 54.27, I sold a option for 142, which is $142. So if I was to sell a similar premium each week, and I have been able to do that over the last several years. So if you collect $142 each week and your original investment is $5,427, that works out to about a 2.6% weekly cash income for this TNA. So if you multiply that by 52 weeks, I'm collecting 136% cash-on-cash return. So again, I already owned this stock. At the time I did this rollover, it was trading at 54.27. So if you were to initiate this position for the first time, buy 100 shares, sell the weekly call, you'd collect a 2.6% premium, $142 divided by 54.27. So if you did that over the course of a year, you're going to collect 136% cash-on-cash return. So, even if TNA declined 20 or 40%, you still have the potential to realize a good return if you're collecting 130% cash-on-cash return. So a lot can go wrong with this trade, and I'll still profit. The underlying stock or ETF could decline substantially, and I could still profit. If I had bad timing on when I entered the trade, I could still profit. There could be volatile price swings in the ETF, and I could still profit. So this gives the weekly covered call strategy a big advantage over stock and option directional trades that require the stock or the ETF to move in the right direction to profit. So in other words, these covered calls can make money even if the stock declines or if it stays flat, because you're collecting that, in this case, a 2.6% or so weekly cash premium. So another advantage of these weekly covered calls is when the market gets really volatile, like it has several times over the past several years, you tend not to get stopped out of your trade as you would with a directional trade. Whenever we purchase an option, we use money management where we'll sell that option if it drops 20 or 30% below our purchase price. So whenever you're trading options, you're always going to risk getting stopped out. With these weekly covered calls, that helps you hold your position during these volatile price swings because you're collecting cash premium each week. So when I roll over these weekly options, over time, I'll get to purchase more covered calls, and that allows me to compound my returns. So here's a couple more examples of actual spread orders I use to roll over weekly options. This is for the TNA, and in this week I collected the 2.5% premium. Here's another example. For TNA, I collected a 2.4% weekly cash premium that week. So this just gives you an idea. This week, I collected a 2.6% weekly cash income. So I've been doing these weekly covered calls for several years, and the premiums have stayed around the 2.5% level for that TNA. So what I'm showing here is just a few snapshots of different weeks. And this right-hand column here displays the amount of cash that went into my account for selling these weekly calls. And this column here lists a description of the call option that I sold. This was Apple, Financial ETF, NASDAQ ETF, Humana, Small Cap ETF, Home Depot. So this represents the cash I received, and this week I received $13,500 in cash income from selling these weekly option premiums. Here's another snapshot. This week I collected $16,000 in cash income from selling these weekly option premiums listed in this column. Here's another example. This week I collected $28,000. And here's another example. This week I collected $19,000. These are all different time frames here, just to give you an idea. And this week I collected $14,900. So I've been averaging about $14,000 to $15,000 a week. And if you multiply that by 52 weeks, that comes out to, over the course of a year, you'd sell $776,000 in premium. So what I did is I looked at my brokerage account transaction reports over the past year, and I did, in fact, sell over the course of a year $751,000 in cash income. And I'll just show you these reports real quick. And this column lists the weekly option that I sold, and the green column here to the right lists the cash income after commissions that was credited to my brokerage account. So over the course of the year, in my first retirement account, I sold a total of $692,000 in premium, and then in account number 2, I sold $59,000. So a total of about $751,000 over the past year from selling this option premium. So that's cash that went into my account. And again, over time, I'm able to compound my returns by buying more covered calls with this cash I received. And what I did is I just took a snapshot. This is my cash income since last month, since the beginning of the year, and I've collected in my 2 retirement accounts about $83,000 in premium income over the past 6 weeks or so. So you can see I'm still active in selling this weekly option premium. So here's another example, rolling over these weekly options. This is for Apple. This was for the emerging market index. These are just different examples of spread trades I used to, in this case, to close out the February 24th options and open the March 2nd weekly options. Now, this is a option chain snapshot I took of, this is for Apple, and at the time, Apple was trading at 585. So the at the money call option at that time would have been this 585 strike. And we can see the weekly option was trading at 1405. So this had 7 days to expiration. This was a weekly option trading at 1405. Now, the monthly option, which expired 7 months later, or or the weekly option, or no, this is the monthly option, yeah, expires 36 days later, so that's 5 weeks later. So the monthly option was trading at 28.30, but over the course of that 5 weeks, if you were trading these weekly options, you could collect up to 70 points in premium versus 28 points for the monthly option. So that just shows you why these weekly options are so lucrative, because you can collect a lot more premium over the same period of time. So here's 1 week premium, 14 points, and you can collect 5 of those compared to the monthly premium, which was 28 points. So that's why these weekly options are so lucrative. And here's another example for MasterCard. The at the money weekly call was trading at 11.90, and the monthly call that expired 82 days later, a couple months later, was trading at 23.50. So you get to collect 12 of these 11-point weekly premiums over the same period of time that you would collect 23 points. So that's a big difference there if you trade the weekly option. So that just gives you an idea why these are so lucrative. This is a snapshot of my 2009 trading contest. And again, I was trading these monthly covered calls because the weeklies weren't available at the time. But by rolling these monthly covered calls over, I was able to get 122% return that year. Here's a snapshot of 2011 weekly covered calls. This account, I had a $323,000 profit, average return of 54%. Here's 2012 snapshot, $332,000 in profits, 36% average return. And so what I wanted to do, lastly, is just compare the income potential for these selling these weekly call options versus, let's say, a CD, just to give you an idea of how lucrative these weekly options can be. And what I did was I compared the investment it would take to generate $50,000 in yearly income using a combination of 1-year CDs and 5-year CDs. And if you wanted to generate $50,000 and you had half of your money in 1-year CDs and half in 5-year CDs, it would take $6,756,000 to generate $50,000 in income. So we saw where in my 2009 covered call account, I had 122%. 2011, I had 54%. 2012, I had 36%. So let's just assume that we could maintain a 33% yearly return for selling these weekly options. Then we'd only need $150,000 to generate $50,000 in yearly income. So $150,000 versus $6.7 million. So now, of course, the CDs are guaranteed, and you can't lose your principal. And of course, covered calls are not guaranteed, and they're higher risk. But I'll take this. I'll take these covered calls, and where I only need $150,000 to generate a $50,000 yearly income. So I thought that was an interesting comparison of yields. So that completes my presentation for today. And if you'd like to get updates on how these various strategies are doing, you can just log on to weeklyoptionalert.com and then click the trade results page, and that'll show you the current trade results for these various weekly strategies. So that concludes my performance or my presentation for today. So I'd be glad to take any questions.
For those of you, we realize Chuck covered a lot of material here, and there's going to be a lot of questions that you're going to have regarding this now. Many people are asking about betas and Greeks, and within an hour's time, it's very difficult for Chuck to basically puke everything out to you and teach you everything. But we do appreciate you trying to do that, Chuck. But we do have some really good questions. Matt Farrell's asking, Do you ever target companies on your cover call strategies with a dividend as well?
Well, the dividend-paying stocks tend to have lower premiums because they pay the dividend, and when a stock goes ex-dividend, the share price is reduced by the amount of the dividend. So therefore, they have their premiums aren't as rich as they are for non-dividend paying stocks. So to answer your question, I prefer the leveraged ETFs as far as the covered call strategy, or stocks that don't pay dividends because they'll have higher premiums.
Chuck, do you have a percentage of your portfolio dedicated just to the covered calls? Is there a dollar amount, a percentage amount? How do you calculate that for your portfolio?
Yeah, in my case, of course, I trade in retirement accounts, so I tailor that to my risk tolerance and my stage in life. So I have about half of my funds in these weekly covered calls.
Do you on purpose sometimes allow some of your positions to get exercised?
If the stock no longer qualifies under the prime trade select rules, then I'll let the option get called.
And I know we have a lot of questions, and Chuck has the support staff number up there that can ask a lot of people these questions. But Chuck, could you fill us in on any forecasts that you have for the rest of 2014? How you feeling about things?
Yeah, that's a good question. I think 2014 will be an okay year. We're obviously not going to have a 30% return in the S&P like we did in 2013, but I'm looking for about a 10 to maybe 15% return for the S&P, which would allow a great return for this covered call strategy, and also for my option strategies. And we've been able to use our trade selection process to pick out stocks that have a much higher return than the averages. Of course, they're higher risk, but to us, it's worth the risk because we've been able to pick stocks that have a much higher return than the averages, and when we have options on them, then of course we're getting a very high return. So we own stocks such as Google. We own the Internet Index, which is far outperforming the S&P. So we look to focus on those sectors that are far outperforming the S&P, and we like to focus on those stocks and ETFs.
I'm going to take over the reins, and I know a lot of people have questions, especially regarding the presentation, because Chuck moves pretty quick. I'm putting on the screen right here. It's mytrademonster.com. We will have this archive tomorrow afternoon, right around the area in February. Chuck has been kind enough to allow us to archive many of his webinars in the past, and he goes into great detail regarding some of his trading aspects and trading prowess in these things. Chuck, I hope you're going to join us next month.
Yes, yeah, I'm looking forward to it. I have a really exciting presentation next month, and what we're going to focus on are certain sectors of the market which are really outperforming, and we're going to look at trading those sectors and really getting a great return. And that's what we've been doing the last several years, and we've had a great success focusing on those sectors. So we're going to look at sector trading next month.
Okay, that sounds great. And again, for those of you that want to go ahead and cover some of the prime select trading, et cetera, and some of the ways he comes up with these, you can come over here and look at Chuck's archives. More importantly, if you do have questions regarding Chuck's service as well as the strategies, feel free to contact his service and they can address anything. Otherwise, Chuck, thank you very much for coming out, and I'd like to thank everyone for attending. Chuck has been kind enough to go ahead and send out a free report called Trading Options with High Accuracy. Chuck's the author of it, and we're going to have that sent out tomorrow afternoon. Otherwise, Chuck, thanks again for joining us today.
Okay, great. Thank you, Tom, for taking the time to set this up, and I hope everybody has a great day.
Yeah, thanks again, Chuck. Everyone, I hope the trading, I hope you learned something today. If you have any questions, again, the archive will be here tomorrow under February. Just click on February. You'll be able to play it back, download it, view it as many times as you like. If you have any questions regarding any of this material, feel free to contact us at mytrademonster.com, and we can address some of the questions regarding brokerage. Otherwise, thanks, everyone, for attending, and Chuck, thanks again for coming out. Have a nice weekend, everybody.
Okay, good night, everybody.